I've been an algorithmic trader for over 6 years now, and these are the biggest mistakes that I've made throughout that time period. So if you're currently trading with an algorithm or considering trading with an algorithm, make sure you watch this video because I'm gonna save you a lot of money and a lot of time. Okay, so big mistake number one, when I first started actually having success trading after a long time of trying to figure out how to manually trade, the first time I actually started seeing somewhat of consistent success was actually with a bot. And that's what got me excited about this whole idea of automation or trading algorithmically. But the first system that I started trading with, I thought it was something that was going to last forever. It was a Martingale or a dollar cost averaging system, which is crazy to say because you see so many that are on the market today. I mean, like probably 90 to 95% of trading systems that you see being sold or that you see on MyFX book or that you see on MQL5 website, they're just simple Martingale or dollar cost averaging systems. If you're not familiar with these systems, Martingale is a famous blackjack betting strategy, and it's a double-edged sword because yes, you can make money consistently with a Martingale or dollar cost averaging system, but ultimately it has its doomsday, and I've just seen this happen time and time again. So if you're unfamiliar, originally a blackjack betting strategy, basically it works like this. If on the first hand you bet 10 and you lose, then you go down and you double and you bet 20, and if you lose that, you double and you bet 40, and if you lose that, you double and you bet 80, and if you lose that, you double and you bet 160, and if you win that hand, then you've made back all of your previous losses, plus you've made that original bet back, which was the $10. So the chances of you losing, like 6, 7, 8, 9 times in a row become smaller and smaller and smaller, obviously, as we're working with probabilities, and in blackjack, you have about a 50% chance or maybe a 48% chance of actually winning, so the likelihood is relatively small. However, if you go and you play blackjack long enough, you'll run it up for a while, and then you'll eventually blow the entire load, and it's not pretty. And so this was my first experience with an algorithmic trading bot, was with a Martingale or dollar cost averaging system. I was making 10% per month. I thought there was no way that I was ever going to lose. I started adding more and more funds, and I noticed some of the times it would go into these really steep drawdowns. And I remember like multiple times just like feeling sick to my stomach, seeing the drawdown go from 10% to like 30% overnight to like eventually getting into like 50% drawdown. And unfortunately, I made a huge loss, with one of these systems. I ended up blowing my entire account. And that's the problem with these Martingale or dollar cost averaging systems, is that you don't know how long a trend can happen. And if you're on the wrong side of a trend, say you're taking buy orders and the market keeps selling, going down, you can really get yourself into a huge drawdown and into a lot of trouble. So this was one of my first big mistakes. A lot of people, when they first get into algorithmic trading, they find these Martingale or dollar cost averaging systems, and they're exciting because you are making money relatively consistently, a lot of the times every day. And it's just mathematically, if you really think about it, it's just really dangerous because nobody has unlimited funds to keep adding into this thing, and you can go from drawdown to really big drawdown very quickly. So this was my first big mistake. My second big mistake was emotionally or manually intervening. I mean, and this was with that first system that I was trading. I noticed that, okay, if I started here and I took a buy and then it came back down further, I'd take another buy, and then it came back here and I'd take another buy. And I realized that, okay, well, the chances are if it's already gone down this time, then it's higher likelihood that it's going to recover. So I'll go ahead and I'll put a manual trade right there because I know the likelihood of this coming back to break even or working in my favor is higher likelihood. And that was really stupid thinking because, again, you don't know how long a trend can go against you. And with other trading systems that I've traded throughout the years too, I've come to think, early on in my career that, hey, I'm smarter than this algorithm. I'm smarter than this bot. And so I would go in and I would manually close out trades if I didn't think the market was going to go in that direction, or I would add on to trades, or I would hedge a trade because I thought I knew better. And, sometimes I did, and I got this false positive doing something that was wrong, but actually getting a good result. And this was a really bad habit that I see a lot of people make. They think they come from this manual trading world and they think they have this expert ability to predict trends and understand chart patterns and candlestick patterns and all this sort of stuff. And ultimately it ends up just biting you in the butt more often than not and makes your life a lot more stressful, and you're not really playing your edge. The beauty of algorithmic trading is that you've ideally back tested your system over historical period, so you have an idea of how the system might work. So manually intervening was a big mistake, and I see a lot of people making that as well. Number 3 was actually thinking that a longer backtesting period meant a better strategy. I traded this strategy that had just this textbook perfect backtest over the course of the past year, and then when I broke it out of the box, it would work for a while, and then it stopped working, and I started losing money. And my thinking at that time was like, well, that was only backtest over the course of the last year, but if I backtest over the last 10 years, then that means that this system's going to be really robust. It's seen 10 years of different markets, and so this means that this strategy must work even better out of the box. And while the thinking it's logically somewhat correct, it's not exactly correct. And the reason being is because you can create a algorithm or a bot to backtest really, really great over any period of time, whether it's a year or 10 years, but at the same time, that doesn't necessarily mean that it's going to work in future market conditions. And more often than not, these systems are overfit, which I'll talk about next, meaning they're too tightly wound to this historical data. And so any variances from that historical data or from those historical market conditions throws the entire system off. So when I tried that, I realized that it wasn't necessarily a longer backtesting period that make the strategy even more robust, although it could, but you have to be using a small amount of variables. You can't use all these different indicators and all this different stuff to get a good result, because you can use platforms like Strategy Quant and tightly wind a backtest to it. The next big mistake was kind of after I had my experience with dollar cost averaging or Martingale systems, which was kind of my first bite of the apple, so to speak. I went on and I was going on the MQL5 website, going on Strategy Quant, and I found myself purchasing this system that I thought was like the holy grail of trading. Again, it backtested over 3 or 10 years, and it just was perfect. The drawdown was very, very minimal, less than 10%, and it was averaging 10% per month returns. And I was naive enough to think that this was actually possible. If you see a backtest like that, chances are it's not really possible. And again, this is just this concept of overfitting, which is, I would say, the problem with 99% of algorithmic trading systems is that they're overfit. What that means is it's too tightly wound or too tightly fixed to historical data. And the analogy that I would say is, if you think about a key, right? It has this certain pattern, a key, and that key may work in your door, right? If you put it into your front door, it works, right? And it unlocks the lock. But if you go to a different market, or you go to your next door neighbor's house and you try to use that same exact key and put it into their front door, it's not going to work, right? Because the conditions are different. So overfit systems mean that you've simply fine-tuned the parameters, the input parameters, which can be indicators, it can be money management things, etc. But if it's too tightly fit to historical data, when you break it out of the box, it no longer works, because we know that past market conditions doesn't necessarily equal future market conditions. And so I made the mistake of trading several systems that I thought looked just amazing in backtest, but they happen to be way overfit. I'd take them out of the box or out of sample or in the forward market, and they'd work for a month or 2 months. And I was like, wow, this is incredible. And then they just completely shit the bed, so to speak, and end up losing money. And by the way, if you're still not using AI and robotics to improve your trading results, what are you doing? AI is changing the world. And in the past 4 years, we spent over $2 million developing what we believe is the best AI trading system on the market, specifically for passing prop firm challenges. So if you'd like to improve your edge and unlock $100,000 or more worth of trading capital, go to www.propfarming.com to see the full demo of how it works and how we can guarantee your success, or you don't pay us a penny. So my final failure that I've learned over the period of the last 6 years or so was not continuing to optimize and change with market conditions. Like I mentioned, obviously we know market conditions are always changing, and that's why backtests are helpful in a sense, but also they don't necessarily mean that the system's going to perform well into the future. And so what we've had the best results doing is both doing a back test and doing an out of sample test and doing a forward test. So back test means you build your system over, say, the last year. Out of sample test means you test how did this system work in a different period in history, like say 2 years ago. And then a forward test, which is how did it actually work in the future market or in the live market before actually trading that system. And so this last mistake was not continuing to optimize and change with current market conditions. And this is what happens to a lot of strategies, a lot of algorithms, is that it'll work really good in one market condition, but the market may may change. Like it may work really great in an uptrend, or it may work really great in a choppy market or ranging market, but then when it goes on a trend, it doesn't work as well. And so what we found the best thing to do is to constantly optimize and change with current market conditions. So we actually built a whole team of internal optimizers that are essentially competing against each other, testing different strategies to figure out what's actually working best in the current market conditions, as well as what has worked historically. And that's the whole idea behind our Hive Mind AI. We basically gathering data from our community of hundreds and hundreds of traders, all pushing it back to one central database so we can see, hey, what strategies are actually working best? And that way we can continue to change and optimize our strategies as the market is continuing to change. Hey, and if you'd like to see more information about how we're constantly changing our algorithms to adapt and work in current market conditions, then go ahead and check out this video on screen now.